Well, good morning. This is Two Gray Beards coming back to you after our emergency Fed meeting. There's been quite a bit of developments in markets in the last 3 days. Nick, what do you think?
I think the first thing I've got to say is that everything I said after the Fed meeting not only turned out to be wrong, but I realized it was going to be wrong as soon as I slept on it. So let's see what just brief word. We've done nothing to the portfolio since the Fed meeting, as I realized that what I was saying was a complete load of rubbish. So let's see where we are now that we've seen non-farm payroll and more importantly, we've seen the ISM. I think the situation is very different from what I said it might be. And that I think that the Fed is going to find it very difficult to pause here and not do at least another hike in March. And the speculation was always going to be that they were going to pause after that and look at where we were. That is still a possibility, but I think that it's the probability that they're going to have to go even further with rate hikes. That probability has increased as a result of these latest figures. The economy seems to be very strong, and employment, particularly, doesn't seem to want to even moderate as it's accelerating. And that's going to have real problems for the Fed in justifying pausing after the next meeting. What do you think, Andy?
Sure. So, I've been more concerned, I guess. And I just wanted to point out both Nick and I manage money in a hedge fund sort of way and have investment research products that are, very aggressive, that differ significantly from what we're trying to accomplish for this long only portfolio. And the events, so I've been for a while now, been very hesitant to be long assets. And obviously, a long only portfolio is a completely different vehicle. But for my hedge fund like activity, I've been very hesitant to be long assets. In fact, I've been short assets. The events of this week made me make a big bet in my alpha portfolio, and that bet was structured as a short S&P 500 exposure. And I think very importantly, and this is what Nick was driving at, short 2-year bonds, because the potential for more rate hikes than is expected. What's expected now is actually fairly aggressive, though less aggressive after the last 3 days, fairly aggressive rate cuts in 2020, late 2023 and early 2024. And I just don't think those are going to manifest. I think any pause, wherever we pause, will be a lot longer than people expect. And so I made a fairly aggressive bet against both of those things happening. One could happen. There could be rate cuts, but that's very bad for equities. Or there may not be rate hikes, and that could be okay for equities, but not great. So that's the bet I've made. And I think what we need to do here is connect how what we do professionally in the hedge fund space is very different than what we're trying to do here. Nick, what do you think about that?
I think you're absolutely right. If you, since the beginning of the year, I felt that equities were going to get ramped up, that a lot of people were short sectors which they shouldn't have been short of. And I felt all along, and I've been saying that one cannot short equities yet. And now I'm beginning to think that this is actually the time to be short of equities. We have achieved several milestones. We've achieved the times 18 multiple of earnings. Earnings this week were not as good as some people would have expected or hoped for. And all that happened this week is that we had a massive gamma squeeze. And basically, people were squeezed out of their positions of whatever they were short of i.e., the higher gamma stocks or higher beta stocks. And now I think people are in a no man's land. If I look at what I think is going to happen to asset prices, I look at it this way. I think gold is screwed. And I apologize for using that word. Why? Because gold yields nothing and it protects the real value of your money. I don't think inflation is going to accelerate here. I think inflation is going to keep on coming down. But the growth that we're having in the economy is going to keep the Fed tight for a longer period. Either we go to even higher rates than the terminal rates that we are at the moment discounting, or we stay there for an even longer period than the market thinks. This gives you negative carry in bonds and notes throughout the yield curve. Market makers hate negative carry, and so do hedge funds, because they will only invest in bonds when they think they will get an appreciation in their value for a short period of time. Otherwise, they are constantly being given day to day a bill, i.e., they have to pay to fund their positions.
Can I stop you there briefly and just
Absolutely.
mention that after this video, I'm going to record an explainer on what carry is and what is currently a very negative carry circumstance for owning bonds and all other long-term assets.
Great. So gold at the moment is probably going to be the worst performing asset, and we've cut our allocation from a higher than normal to a lower than normal level, i.e., we are underinvested in gold. And I think gold is going to be the worst performer because you have uh, coupons, i.e., bonds, give you a yield. Gold doesn't. So gold, I think, is going to be the worst performing asset, followed by bonds, followed by equities. But I think everything is going to go down. Equity valuations are very high relative to what they should be, and therefore I think stocks will go down as well. They might not go down as much as bonds, but that is, we are basically at very close to minimum allocation in our bond portfolio, sorry, in our stock portfolio, and therefore we don't feel that we need to cut it very much. We are at a reasonable exposure and not that duration heavy in bonds. Therefore, we feel that, I mean, my feeling is that all we need to do is sell some calls against our bond portfolio, sell some calls against IEF, and sell some calls against TLT for the next couple of weeks. I think those are dead money. Uh, there is no way that bonds and notes rally over the course of the next couple of weeks after those employment numbers and those ISM numbers on Friday. Would you agree with that, Andy?
So I agree with the tactics, and I just want to put those tactics in context. Last week, became bearish gold, and as a hedge fund, I would have been short gold and happen to have been short gold. But as a long only investor, what we did is what we think we all long only investors should do. It's up to you if you want to make a big bet. That's an alpha bet, that's a hedge fund bet, that's an aggressive bet. That's not what you're here for. What we did is we went from overweight to underweight gold and happened to got lucky and called the absolute top in gold on our sale. Um, that's what we're doing here. And we're never going to be short any asset, and we're going to be allocated in a balanced way with some overweights and some underweights. And what we're saying now about our existing allocation is that we're already underweight equities and don't see a need to go to minimum equities, though we do think they're going down. And we're modestly overweight, but very relatively short duration. We're not overweight 30-year bonds. We're overweight sevens to tens. And what we think is the right thing to do there is to recognize that they may go down. And if they do, we're a bit exposed. So writing calls, at the money calls on our existing bond position, if we're wrong and they rally, we go to neutral weight by selling some bonds on the exercise of those calls. If we're right, this will protect us somewhat. And so it's a tactical decision. And I think it's the right decision in the environment because it still is, I agree that there's very little data next week. We normally break this presentation up into what's going to happen. And on the what's going to happen side, there's very little data next week that could be market moving. There's the tail end of earnings season, but the economic data is light. And so there's not a lot of stimulus for bonds to rally against this now higher for longer sort of narrative that's building. So we think this is the right thing to do in the near term. And next week we may do something more aggressive. But the high level point is we are already heavily allocated to cash, underweight equities, now underweight gold, which is our least favorite asset, and modestly overweight bonds, but also given the amount of cash and duration we have, still very light assets, which is consistent with our damp spring view, which is my alpha product, and Nick's charity hedge view, which is his alpha product.
Absolutely. And now this portfolio is actually more or less in sync with our hedge fund products. We are basically at the lowest level that we feel comfortable being long assets in a long only portfolio. So I don't think there's any dichotomy there. We are perfectly aligned. And if people want to be more aggressive in their allocations, they're perfectly welcome to be. But this is not what this product is designed to do. This product is designed to have a decent long-term performance with lower volatility that you might expect from a pure 60-40 portfolio in the long term.
Indeed. Nick, one thing I was thinking about was, what sort of catalysts, what sort of events should our listeners and viewers be paying attention to next week? Do you see anything on the horizon that matters much?
I don't think so. I think the fact that people have been squeezed out of their positions will turn out to be probably the most important factor.
Right.
I.e., they need to reestablish different positions, and that's going to give us all the volatility we're likely to see next week, in my opinion.
Yeah, I thought that you made an interesting point in a side conversation we had regarding the Dow Jones versus the NASDAQ or even more speculative areas of the market.
And this ties in with what I've been saying. I mean, if one looked at just the Dow last week, the Dow was down, while the Nasdaq was squeezed much higher. And this is what I've been talking about. These high beta stocks, they were squeezed. People had to basically chase them. I mean, I've heard some horror stories about what happened to certain desks, but that's neither here nor there. What the way we took advantage of it is basically we got rid of our high beta uh, part of the portfolio, which was long XLY. Now, had we waited an extra couple of days, we would have got an extra couple of percent. But that's neither here nor there. That's not what we're here to do. We're here to basically sell into strength when we think things make no sense and to be able to therefore buy later at a cheaper level when we think the valuation is appropriate.
Right. And so that point on so there's this idea of fear of missing out, FOMO, that a lot of investors are exposed to. Chasing winners is a very popular and dangerous activity. And so I guess the thing I'm looking at, as I say, there's not much news. The thing I'm looking at is whether that spread between the high beta stocks, and you can just use NASDAQ, and the Dow, which is a much lower volatility asset, converges a little bit. And I expect it to converge a fair amount. And that's because the earnings from the big tech have come out, and they were they were below expectations in most, if not all, cases. But if you step back and you look at the trend in earnings, it's not about expectations. It's just literally what the earnings were. Earnings have turned, and they've begun to decline year over year. S&P earnings will actually be close to down, if not down, after everyone reports. And let's bring that back to Nick's ranking of assets points. So I agree with it broadly. Gold is fallen a lot, so it's I'm not running out and shorting it here, but it's certainly not going to go up in the environment we have. So it seems to be the most vulnerable asset. I agree. Long-term bonds, they're not going to go much lower, but they will trend lower. Equities to me is the question. And I guess I'd be a little bit more bearish than Nick. But again, for a long only portfolio, we're very underweight. And the reason why is I think that premium, that fear of missing out premium, that is that spread between the Dow and NASDAQ and basically anything that's high beta, is bubbly and may deflate a little bit in the coming weeks. We'll see. That sort of thing can last longer than you might expect. But that's, I guess, where I'd come from. I'm looking at that bubbly nature of some of the equities. And though the earnings I mentioned are coming down, the economic circumstance is still supportive for earnings. And I think that's why bonds are going to perform worse.
I would agree. And if anybody wants to have a look at the relationship between multiples and earnings, we have a link in the Excel file to the Blue Angels from Yardeni, and that's pictorially very, very interesting to look at.
Okay, I'm talking too much and we're running a little late. Um, what are we going to do with the portfolio?
I think, as we said, we're going to sell calls against TLT and sell calls against IEF. And next week, probably, if the market does behave the way we thought it might, we might sell some puts against struck at the right level, mind you, struck at the right level against something like SPY if it does come down.
Sounds great.
And here are the orders. Ignore the levels because I won't know them until Monday morning. Uh, but the quantities are right. So we're selling the 106.5 calls to February 10th in both IEF and TLT. We're selling 2 in TLT and 4 in IEF. And whatever level we get on Monday morning we'll be satisfied with. And finally, just a quick reminder about the contents of the Excel file that's uploaded with each episode. Here you have the approximate allocations to the various asset classes. In the chart pack, you have the charts to those. And if you set up a TradingView account, you can then download these into it. And you can watch every single ticker and the levels that we are looking at and why we're looking at them. Broker statements, of course, contains the exact statements to those dates. The order entry, here it is, what we're doing next week and what we'll be in fact doing first thing on Monday morning. And finally, research and resources. As I've done in a previous video, I have shown you now that all the research from all the investment houses we follow is updated daily. And also here we have some economic calendars, so you can have a look at what is happening next week in terms of economic releases and some recommendations there. This is the one that we mentioned today. And here we are. These are the Blue Angels by Hedge. And here you have a very nice pictorial representation of what the earnings are doing. The earnings are slowly deflating. And this is where we are at the moment. We are at times 18 earnings, and we think that is expensive. I just wanted to show you those links so you can look at things yourselves whenever you feel the need to. Thank you.
Have a good day, everyone.
Have a wonderful time, and we'll speak to you next week.